Good evening, everyone. Welcome to the Australian Expat webinar we're running in conjunction with myself and Ashley Murphy from RTA Wealth Australia. My name's Brett Evans. I'm the Managing Director of Atlas Wealth Management, and I'm pleased to and humbled that you've given us your time this afternoon and this evening, whether you're located on the East Coast or the West Coast of the United States. We'll run through the seminar today. We'll try and keep it punchy and short, then obviously open up to any questions and queries that you may have later on. We've just got quite a few more people joining on right now, so we'll just keep talking for a couple more seconds just so they don't miss out on the presentation. And then I'll be handing it over to Ashley. So obviously a little bit about myself and Ashley. Both of us are Aussies, which puts us in the unique situation where we can have two conversations in two different jurisdictions. So we're cognizant of the issues that Aussie expats face on a daily basis, both in the United States and in Australia. And with both of us, we've been working together for a number of years now in providing almost like a bookended presentation and a solution to Aussie expats in the States. So without further ado, what I'll do is I'll hand it over to Ashley, and he can begin his presentation.
All right. That sounds wonderful then. So I am going to share my screen, and let's take it from here. So we should all be seeing everything you need to know about the U.S. financial system in about 20 minutes. Okay, so just making sure the settings are correct. So I'm going to get into it here. So everything you need to know about the U.S. financial system. All right. First of all, no presentation from a financial advisor would be complete without disclosures. This is general advice. Doesn't constitute personal financial advice. A little bit about me. I was born in the UK to an American mother, Aussie father, and therefore been a tri-citizen from birth. Raised in Brisbane, Queensland. Went to UQ undergraduate in IT business management. Moved to the US in 2005, worked as a corporate financial analyst, including with Babcock and Brown for a period of time. Saw the light in 2008 and started in the Certified Financial Planner program, which went extremely well. Won several scholarships and have been fortunate enough to develop relationships with some of the most influential people in the business. I was the secretary of the Next Gen Financial Planning chapter from 2012 to 2013, founded RTA Wealth Strategists, which is a co-brand of RTA Wealth Australia, 2013. Presently studying a graduate diploma in financial planning in Australia, and I've been to the Financial Planning Association conferences in Australia twice, and have been a member of the FPA there. I'm also a professor in the financial planning program at Golden Gate University. I've been quoted in the Wall Street Journal, Financial Advisor magazine, Think Advisor, and a couple other places. So very quickly about my firm, two brands, as I mentioned, RTA Wealth Strategists with a domestic focus, and RTA Wealth Australia with an international focus. So the clients of RTA Wealth Australia are based on the East and West Coast and some in Australia. And the common values to the firm are we really try and be as efficient and paperless and virtual as possible, and we believe in bringing our clients overall life satisfaction as best as we can through better financial decision making. So here's a range of services that we offer. As you can see, there's a lot of different things that we consider by subject, and they vary, those subjects vary by the phase of the move that someone is dealing with, whether they're just coming in for a short period of time or whether they intend on remaining in the US for the rest of their lives. So here is a diagram showing just some of the partners that I work with. You'll note top of that list is Atlas Wealth Management. Brett is licensed in Australia, I'm licensed in the US, and together we're able to provide comprehensive global financial planning and investment management services to our clients. And whenever any of these other things come up, we've got developed relationships with these other individuals that we're able, and this isn't a complete list, by the way. It includes mortgage brokers in Australia and in the US that specialize in dealing with expats. So getting to the guts of the presentation here, 5 points I wanted to cover. How your immigration plans and status should determine your strategy, your financial planning strategy. An overview of the US tax system, managing investment accounts in the US, retirement saving strategies while working here, and lastly, a brief overview of employee stock options. So the US is an interesting country. It's the only other country apart from Eritrea that taxes on worldwide income. Worldwide income. That is to say, if you are a US tax resident, you're reporting and potentially paying taxes on all income or capital gains generated anywhere in the world. That means foreign investment accounts, investment property, and yes, superannuation accounts. Immigration status. The reason this is important is because depending on your status will determine whether you are considered a lawful permanent resident of the US. Permanent is a funny word, that's why I put it in quotes there. But if you're a green card holder or a citizen, doesn't matter where you are a tax resident of the US and subject to that worldwide tax system that I mentioned. If you're a visa holder or any other kind of temporary resident, you are subject to the substantial presence test, which you can see I've defined here. Essentially, it boils down to if you had spent 120 days in the country in the prior 3 years, using this formula here, 1/6 of the days 2 years ago, 1/3 of the days last year, and really if there's a single day this year, you're going to exceed that 183-day status and find yourself subject to that US worldwide income tax system. When I first moved here, I thought that Americans were making a grammatical error. They'd say, I pay too much in taxes. In Australia, you don't hear that. Say, I pay too much tax. But they're right to use the plural because there really are multiple taxes, and we'll talk about some of them very briefly. So there's federal, state, local, FICA, Federal Insurance Contribution Act, that's your Social Security and Medicare tax, and the net investment income tax, which came into effect in 2013. Medicare surtax, don't forget, a bonus tax of 0.9% payable on all income above $250,000, which we'll also talk about shortly. In the slides, which we'll make available after this presentation, you'll see I've got a link here to a brief 26 pages, overview of the US tax system. Another major difference to the US tax system is they have this thing called a filing status. So in Australia, everyone is essentially, to use US parlance, is a single tax filer. In the US, you need to choose because the filing status that you choose will be highly advantageous if you choose the right status and disadvantageous if you choose the wrong status. This becomes more of a strategic decision for permanent residents living overseas who may have a non-resident alien spouse, and choosing that will determine retirement contributions and what tax they're going to owe. Okay, so here's a demo pay stub we see right here. You can see the two highlighted lines, federal withholding tax and California withholding tax. So when we're talking about federal taxes, we're talking about that top line item only. That's it. That is the one tax that your federal, what's called 1040, Form 1040, is your federal tax that is submitted. And it's only dealing with that one line item. You have to submit a separate tax return to the state that you live in. If you happen to have the privilege of living in New York City, you also pay a local tax, which is collected on your state tax. We can see here the other two items, Social Security tax and Medicare tax. These are other payroll taxes that are due, 6.2% for the employee, and the business owner folks on the line tonight will know that they also pay another 6.2 for 12.4. There's a minor offset, so it's not a full 12.4 to the business owner, but nevertheless, it is a hefty sum of money that we're talking about. Medicare tax, 1.45%. That goes, that does not phase out at any level. That's to say, you pay that 1.45 up to $1 million if you happen to make $1 million. I should have mentioned, as you can see here on the Social Security point, you only pay that 6.2% as an employee up to $118,000. Then you're capped out. When the Affordable Care Act came in, so did the Medicare surtax, and that's that bottom bullet point you see there. It's an extra 0.9% for high-income earners above married filing joint above $250,000. Congratulations, you get a bonus tax. So let's add them up. We've got federal, state, local, Social Security, Medicare, which is FICA, capital gains and net investment income tax, which we have not spoken about, and the Medicare surtax. You're looking at some pretty hefty marginal rates. So tax management in the US is a very important thing. And it's also a very important thing if you're not in the US, but you find yourself subject to the worldwide income tax. Other taxes to quickly cover: capital gains tax, very similar definitions of what constitutes short and long term as in Australia. If it's a year or less, you're talking about short term. Charge your marginal rate, your federal marginal rate. So no benefit at all to that. Long term, and it drops down quite a bit, and I've got a brief graphic on the next page to illustrate that. Foreign income taxes here. So I've mentioned that several times. Worldwide tax net that you need to watch out for. It includes all of those things, and a strategy needs to be employed when we're considering foreign income tax. Do you apply for a credit or an exclusion? That will be covered in more detail in a future presentation when we're talking about American expats abroad, particularly in Australia. So this is a neat segue onto the next topic. Some assets, such as foreign-owned or originated mutual funds, ETFs, they receive this punitive tax treatment, and active planning is required to mitigate these effects. We'll get onto that in just a second. But look what we have here. This is a snapshot taken from my key financial data sheet. Never leave home without it. And you'll see here a few tax brackets that I've identified and where some clever planning can really pay big dividends. You'll note that the long-term capital gains rate for married filing joint clients, if they have an adjusted gross income of less than $75,300, the capital gains rate is 0%. That's very nice. Conversely, however, get into that highest marginal rate, the 39.6, and you graduate another 5% to be in a 20% long-term bracket. Okay, so as I said 2 slides ago, alluding to this this tax system that is intended to catch foreign mutual funds, we were talking about the passive foreign investment corporations, or PFICs as we call them. This came about from the Tax Reform Act of '86, and it was essentially devised to avoid foreign funds being able to roll up gains and income from within their returns and not declare them to the IRS, which, of course, the IRS did not like that very much, so they came out with that law. And here's the tax treatment that it actually attracts. We're talking about the highest, not your highest marginal rate, but the highest marginal rate that is going to be due on the income, capital gains, and deferred gains from within the fund. So very harsh tax treatment. And here's the extra bad news. The Australian superannuation system, which is considered a foreign trust by the IRS, it was not set up with the intention of complying with what the US defines as the necessary attributes for a qualified retirement account. Why would they? After all, separate sovereign governments. Therefore, we have the misfortune of superannuation accounts also being classified as PFICs. Okay, so what are your choices? Let's talk about options here. Well, one option is you can complete a certain IRS form and nominate these funds as being qualified electing funds. Generally, not a good idea. However, occasionally we'll have clients that have very highly appreciated stocks, don't want to realize the gains in that and pay the taxes. They know they're only going to be in the US for a finite period of time, may as well pay a slightly higher tax rate for that period of time and not have to crystallize those losses. That's one strategy. Second would be to own direct stock, meaning you own shares of that company, shares in Telstra, shares in Wesfarmers, whatever the case may be, as opposed to listed investment companies or other managed funds. And your third option would be, and this would make sense for depending on your immigration intentions, for the sake of simplifying your financial life, would be to repatriate your assets to your country of domicile. Domicile means where you intend on living forever. Okay, so really quickly, after-tax investment accounts, you'll hear them called brokerage accounts in the US. Many different titling options. It's largely a topic to do with estate planning. 90+% of the situations we'll see will involve either individual or joint titled accounts. Retirement accounts, many different types here. we're largely going to be talking about this employer-based 401k, because that's what most folks coming into this country are going to, the type of retirement account they're going to have. Okay, so here's a quick breakdown of your choices as for how to go about investing. You can do it yourself online with Schwab or TD Ameritrade. You could use Betterment, Wealthfront, this new breed of robo-advisors that have come out. But really, what are they doing for you? They're investment. They're not robo-advisors. I reject that term. That's just what they're called. They really should be called robo-investors, because there's no advice. It's simple investment allocations and tax loss harvesting. With the fancier ones, you get tax loss harvesting. That's not even with all of them. Many people on the line tonight might be with a domestic financial planner, and we would make the argument that being with international wealth managers such as Brett and myself provides you with that comprehensive and coordinated advice that is going to cost the same amount of money. It's going to reduce your compliance and greatly decrease the time required, given that we know how the different tax codes interplay with one another. So let's talk about retirement strategies, retirement savings strategies being in the US. So if you intend on staying here in the long run, then, and actually it's the same if you don't, but the first thing you want to do is fully fund your 401k. If you're going to be in the long run, you then want to look into a backdoor Roth IRA, another whole conversation involved with defining what that is. And for clients in higher income tax brackets, they might look at other tax, what we call in my firm, tax asset classes, such as cash value life insurance, muni bonds, 529 college savings accounts, for instance. And then once those goals and accounts are fully funded and on track, they might look at after-tax investment accounts. If you don't plan on staying in the US in the long run, you might consider fully funding your 401k, which would then be the next thing we'd advise you do is to go straight into an after-tax investment account. A question that is probably on everyone's mind is, what is the most tax-efficient way to get your money back to Australia, out of your retirement account and out of your investment account? Well, there's a couple things involved with that. Let's talk about if it's in your 401k. Well, there's a provision in the tax treaty under Section 18 that deals with foreign pension accounts. And here's the important definition, is it's to do with foreign employer-sponsored pension accounts. So that's a 401k. It so happens that the contracting state to the treaty is you're able to take that distribution potentially tax-free. We'd encourage you to talk with one of our international CPA partners to get further clarity on that, but that is essentially what we're looking at. And then with some strategic funding of your super account, you may well be able to get up to $100,000 a year for 5 years into that account tax-free. That would be the ideal situation. Foreign exchange, it's always a hot topic in social media. For clients, we're able to achieve an interbank exchange rate, which really can't be beaten. Very, 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 very quickly, going to talk about IRC, Internal Revenue Code, Section 83. Why am I talking about this? Because this is a prelude to talking about equity compensation. That is, we're talking about stock options and restricted stock. The whole point of, well, not the whole point, but a large point as to why these forms of compensation came to exist is because it is not deemed income in the year that it is granted to you for these two reasons that you see here. There is a substantial risk of forfeiture that you might not actually receive it due to a service component that you may not fulfill, or it is not transferable by the employee until a certain time has elapsed. So it's not currently recognizable income. So looking here at different types, we're looking at restricted stock, simply stock you can't transfer until a period of time has elapsed. RSUs, restricted stock units. What's the difference between that and restricted stock? Essentially restricted stock, but it's like a ticket whereby once the period, the vesting period has elapsed, then you get the stock. So you don't actually have stock, you're not entitled to dividends, voting, nothing. You've merely got units that represent shares that may be redeemed after a period of time for stock in that company. Incentive stock options, we have a guide that we've written, and I'll have a brief link on how to exercise in the most tax-efficient manner your ISOs. NSOs are talked about very briefly in that guide. So a few dates that are common to all forms of, or most forms I should say, of equity compensation. That is the grant date. On what date did the company give you the equity compensation? The vesting schedule and vest date. So they might say, if you work for us for the next 3 years, you are going to vest progressively over that period of time and then have 100% unrestricted ownership of that holding after that period. And then the exercise date applies particularly to options. So the exercise date means the date where you turn your option to own stock at a certain price into, you pull out your wallet, you pay the option price and the exercise price, and you actually come to own fully ordinary paid shares in that company. So you've converted from options to actual fully paid shares. And then there's the sale date of the actual stock. So restricted stock is not an option. Let's be clear about that. It is stock. It is, you have dividends and voting rights. Grant date is the same as the exercise date. Oftentimes there'll be a bargain element. What's that referred to? Essentially, the employer gives you a discount. You're able to purchase that stock at a price lower than the fair market value. Now that bargain element is taxed as ordinary income. Provided you hold the stock for more than a year, you'll get long-term capital gains treatment, which, as you'll see in the old key financial data, is substantially better than most of the marginal federal brackets. And I quickly covered what RSUs look like. So incentive stock options, you're able to be granted up to $100,000 of ISOs on an annual basis. And they get kind of complicated, which is why we wrote the guide. But let me give you a brief overview here. So in this example, there's a 3-year vesting schedule. Then you've got your 1-year waiting period. And then beyond your 1-year waiting period, you'd be able to conduct what's called a qualifying disposition. Okay, so in day one, the company offers you these options at $5 per option. Now, the stock of the company happens to have a fair market value of $10. So you've got a bargain element in there of $5. So you're able to buy the stock, correction. You're able to buy the option for $5, and then you'd have to come up with another $5 to get the stock at $10. But you have 3 years to wait. So 3 years are up. Now your option price hasn't changed, the exercise price hasn't changed, but the market price of the stock has gone up by 50%. Now it's worth $15. So look at that. You've got an embedded $5 gain. It's tempting to some folks to then sell that and be done with it, but that's a bad idea because that results in what's called a disqualifying disposition. You need to have a qualifying disposition. There are 2 conditions that must be satisfied. One, the holding period before exercise must be at least 1 year. Got to wait a year before you exercise. And then once exercised, you must wait another year for a total of 2 years from grant to sale to get long-term capital gains treatment. And as you can see in this example, we bought our option for $5 when the stock was worth 10. We exercised it at 10 and then eventually sold it years down the road at $25, which means we crystallized a $20 a share long-term capital gain, which resulted in big tax savings. So really wrapping up what I'm trying to say here, long-term plans make all the difference to cross-border financial planning. You need to think about, are you going to stay or are you going to be returning to Australia? That's going to have big implications as to your investment strategy. Will your family move with you to the US? And if so, is your spouse allowed to work? Are your children of an age, and is your visa of a type where your children might run into visa issues being able to actually get a job once they get to that stage? Do you maintain real estate overseas? If so, you're now looking at foreign sourced income and will need to fill out tax returns in these foreign jurisdictions. Will you qualify for Social Security? Yes, you will, due to what we're talking about here in the next line, totalization agreements. That's to say that the US and Australia and various other, mainly OECD countries, have an agreement where by paying into your retirement system, you're also vesting in member member totalization agreement countries. But that's not the case with Medicare. So if you came at an older age and didn't spend your 10 years becoming vested in the Medicare program, well, you might find yourself out of luck come age 65 when everyone moves on to the US government healthcare program for retirees. And then there's government pensions, not so applicable to Aussie expats finding themselves in the US, but there's the IRS has a thing called the windfall elimination provision, which reduces your pension because they see you getting a pension from a foreign government. To downloads, you can go to my website. If you go to arate-wa.com, under the media tab, you'll see the key financial data for 2016 and the guide to incentive stock options. And there's my contact information. And thank you very much for listening. I'm just going to pass the screen over to Brett. Okay, Brett, can you confirm that you received that request?
I can. I'm just bringing it up on the screen now. Okay, can you see my presentation there, actually?
Yes, I can.
Okay, fantastic. Well, good evening, ladies and gents. I'm going to talk on the Aussie side, and virtually what you'll find is a lot of cross-pollination between what Ashley had to talk about and what I talk about. And this is often what we say to clients. It's important to have both ends covered and make sure there is actually a meeting in between of your financial advice, because at the end of the day, if one advisor is taking in this direction, the other advisor is taking this direction, you're not going to get the proper advice. So let's run through our presentation and just talk about the basics of the three key areas we find that Aussie expats are dealing with key financial issues in the United States right now. A little bit of information about me. I'm the founder and managing director of Atlas Wealth Management. We currently provide financial advice to Australian expats in over 18 countries. The best way to describe our services is extend out to the Australian waters of the coast of Australia. Any asset or financial obligation or issue that pertains to your circumstances in Australia, that's where we come into providing financial advice. We've been featured by a number of media publications, and we're constantly called on by a lot of media to discuss expat issues. The Australian government, at the end of the day, does a very poor job in communicating with Australian expats, especially with respect to legislative change, changes to super, accounting tax laws, and we sort of take it upon ourselves to get out there and discuss that with Australian expats. So we're in the fortunate situation of being able to use the media a lot of times for that, but also too, social media is a very big part of our communication, and I encourage you to follow us on our respective social media channels to stay up to date. This year I was fortunate enough to receive the Innovator of the Year award for the specialised work we're doing with Australian expats, and it's something we're very proud of, because we're the only Australian financial services firm that specialises in providing financial advice to Australian expats. We've been doing it for the last 5 years, and we're sort of blazing the trail when it comes to providing applicable and appropriate compliant advice to Australian expats. So we're very proud of the work we do, and I hope you enjoy this presentation. So the first thing we're going to cover off on is how to manage your super. Long story short, most Australian expats have super, unless you're a uni graduate and you jumped on a plane the next day after you graduated. 9 times out of 10, you'll have some sort of super sitting back in Australia. So we're just going to run through some of the key areas that we talk about with clients with respect to managing super, and particularly managing your super while you're an expat in the United States. So, and this is, you may or may not be surprised by this, but the IRS is yet to issue a definitive guidance on how super is classified. So years gone by, Australian expats did make up a big part of the expat pool in the United States. Now, all depending on who you talk to, there's between 150,000 and 200,000 Australian expats in the United States. It's something that we're actually taking on board ourselves, and we're actually in the process of trying to talk to Canberra about getting this raised and getting a definitive classification, and to try and get Australian super accounts classified as a foreign pension account. As an example or comparison, UK pension accounts are classified as foreign pensions. Unfortunately, in the case of Australia, they're classified as a foreign trust, or more particularly a foreign grantor trust. Now, what this essentially means is the biggest thing that we find with clients is they get so much conflicting advice with respect to how to treat their super. And up until recently, it hasn't been a big issue because I guess ignorance has played a part. Also, too, the regulatory authorities haven't had the ability to keep track and monitor the respective pension accounts overseas. However, these days with FATCA, with data sharing, the world's becoming a lot smaller place, and it's not very hard for the IRS to find out some information from Australian financial services providers because of the FATCA agreement. Now, one point I'd like to point out is even though under the FATCA agreement, super funds are exempt from reporting details, some are. So we're saying to clients is best to be on the front foot, manage your super fund in a compliant fashion, and don't kick the can down the road and think, oh, I'll worry about it later on, because as Ashley pointed out, the IRS has no tolerance for fools, and they're always happy to levy a fee on any inaction. We don't agree with the classifications of foreign trust, because at the end of the day, you as a beneficiary, most of the time, you're not also the trustee of that. You'll be a trust company of Australia, BT, one of the major corporates as a trustee. So we find that a lot of the time with a lot of these people, they don't understand the process. It's going to be a long process in terms of trying to get this ship turned around and managing it in a compliant way. So in the meantime, let's run through some of the key items that we discuss with clients. This is more particularly with Aussie expats in the United States, but long story short, we actually recommend totally reconstructing your super fund. And the reason we do this is, as Ashley covered off very well, PFICs are a very big issue when it comes to managing super. So PFICs are managed funds, listed investment companies. Those of you who have been following markets for a while might be aware of companies like Argo Investments and Djerriwarrh, but also too with the I guess the popularity of ETFs and other types of issues that are starting to appear in client super funds. We need to make sure that the super fund is managed in the most compliant way until this issue with the reclassification of Australian super funds is done, which, to be honest with you, will be many years away, but the process starts with one first step. The second thing we recommend clients do is limit the turnover. Now, the way that the IRS manages and controls super funds is they look at two things: capital gains and also income that's been accrued inside the super fund. So if you limit the turnover of a super fund, then you are limiting the capital gains that have been crystallized. We also recommend you try and run the portfolio on a low yield. Obviously, the higher the yield, the higher the chance of you paying tax at the personal level for income that's been created by the super fund. So if you can bring that income level down in that super fund, therefore you're hopefully deferring and abating any large tax bills with respect to managing that super. So they're the three key issues that we find with clients with super funds. Years gone by, super funds you didn't have a lot of control on. Today we can do quite a fair bit with it. Short of having a self-managed super fund, which that's a whole topic for another day. But a self-managed super fund, in the past was the only way you could really control super funds. These days, we have the tools at our disposal where we can do these types of changes and manage these types of accounts in a very compliant way, which is, obviously cognizant of the fact that you're an expat, but also to cognizant of the fact that you're an expat in the United States. The next thing we want to talk about is, on review of the latest super statement, you may find there'll be elements in there that refer to life and TPD insurance. Now, when we review client super funds, one of the first things we do is we speak to the super fund and have a detailed chat with them. You've got to remember too that when you do speak to super funds, you are speaking to a call center. You're not speaking to a financial advisor. You're not speaking to someone with a high level of technical experience. So they virtually have a script that they read from. And quite often we find is when we speak to these guys, we say, is Joe Bloggs he's a non-resident for tax purposes. He lives in the United States. Is he covered for life and TPD insurance that he's currently paying for in his super fund? Now, more often they say, yeah, of course he is, because they interpret that as he's only on holidays. But you need to dig deeper. You need to go and say, I live in the United States, I'm a resident of the United States, am I still covered? At that point, they'll usually put you on hold because they don't know the answer. They'll refer to a team manager or someone of seniority. And in 80% of cases, or sometimes more, they come back to you and say no. We often recommend, we do this over the phone, but obviously if you are doing this yourself through your super fund, we recommend you do it on the email, because what you want is, if anything happens, if they say to you, yes, you are covered for life, or yes, you are covered for TPD insurance that's currently in your super fund, and something happens down the track, you want to be able to present that letter or that email to the super fund when it comes time to claim. Super funds are notorious, and more so the insurers are notorious for finding ways to get out of paying out. So by having that ability to present that document to say, yes, you confirmed to me that I was a MA non-resident for tax purposes living in the United States. Yes, my life and TPD insurance is valid. Therefore, I would like a payout, please. So that is a very key issue. We've got clients that go back to being overseas since 1994, and they've been paying premiums on both life and TPD. And even though that they've been paying those premiums, there's actually no chance of them being paid out should the need arise. So that's a very quick way that you can work out how to save some money inside the super fund, is if your insurance is not valid, turn it off. The next thing we want to talk about is how may the new HECS and HELP debt and also TSL changes for Aussie expats affect you. Now, this has been pretty well broadcast in the Australian media, but to a lesser degree overseas. We've been trying to use our social media channels to educate and update expats, because this is a very new change. A lot of expats do have HECS, HELP and TSL debt, and up until recently you haven't had to make a repayment back. It's been a smart strategy to make payments, because obviously your debt does index, but at the end of the day, most people have sort of said, oh, I'll just let it sit back in Australia and I'll worry about it later on. Well, now's the time to worry about it, because as of the 1st of July next year, you are going to be legally required to start repaying HECS and HELP and TSL debts. So what is the best strategy from here? Well, we always say try and repay it before that regime starts. And the reason why we say that is because once that regime starts and you have an outstanding HECS debt, you're going to have to complete a quasi tax return with the ATO to disclose your worldwide income. Now, I'll speed it up a bit more. Up until the 31st of December this year, the ATO is offering a 5% bonus on any payments greater than $500 in paying off your HECS, HELP and TSL debt. So what that means is if you make a transfer before the 31st of December, they'll actually give you a bonus. If you make a payment on the 1st of January, they won't give you a bonus. So if you do have the financial means to be able to put money away and pay it off your HECS, HELP and TSL debt, do it before the 31st of December to get that 5% bonus. While that is the best strategy, we're obviously cognizant of the fact that a lot of expats may not have $20, $30, $40, $50,000 sitting around to pay off their debt. So we'll go through now the second strategy we've been employing for clients, and that is to start to prepare for that payment regime that comes in on the 1st of July next year. So long story short, if you're Australian, and I always refer to Australian dollars because obviously the currencies do vary, but from the 1st of January 2016, if you have moved overseas, you are required to make HECS, HELP and TSL debt payments. Now this is for expats who have just moved from the 1st of January or are planning to move in the next 6 to 12 months. For those people who are already overseas as of the 1st of January, your payment regime comes in and kicks in on the 1st of July 2017. The one thing that's very poorly broadcast by the ATO and the Australian government is if you become an expat today, let's say for example you move to LA or Albuquerque or New York, you have 7 days to notify the ATO of your new contact details. Now, typical ATO, they want it done in their fashion, so they're directing people through the new my.gov website. But the problem is a lot of people don't have that set up. So what we're saying to clients is contact us, we can point you in the right direction. I'll run through some numbers in a sec that you can call to help get that set up. Be very patient, brace yourself for a lot of queues. It's not an easy process, but then again, when dealing with the Australian government, when is it? If you're living overseas and earning overseas income, then if you are above the threshold of 54,869 Australian dollars equivalent, then you will need to start making HECS debt payments next year. So what we've been talking about with clients is you can almost foresee approximately what your payments are going to be, and we'll run through that in the next slide. So how do you find out your balance? Now, most people, they haven't looked at their balance probably since they left Australia. The quickest and easiest way is to talk to your accountant. Now, if you don't have an account in Australia and you have someone, you don't have anyone else you can call upon to find out that information, the next step is setting up a my.gov.au login. A lot of the Australian services, including ATO, Centrelink, Medicare, everyone's going through this website portal now, which in theory is a great idea, but obviously a lot of expats have been overseas before this was set up. So there is a bit of work to be done to set this up. But the good news is there's a number you can call. It is open until 10 p.m. Australian Eastern Standard Time. So the times do overlap a bit with the United States. If you want to speak to someone regarding your HECS, HELP or TSL debt directly, then you are going to need to call between 8 a.m. and 5 p.m. So they're not working as late, unfortunately, but if you have your tax file number, date of birth, the usual ID questions, then they'll be able to disclose it to you over the phone. So the next step is determining approximately what repayment threshold you'll fall into. And remember that these amounts are in Australian dollars. So if the Australian dollar does come back over the next couple of months or the next 6 months, then you're going to have to adjust your figures to take into account that new exchange rate. So on the table on the right here, what we've done is outlined some of the key thresholds that you need to keep in mind. As an example, let's say, for example, you are earning 100,000 Australian dollar equivalent. Therefore, you will fall into the 7.5% tax threshold. What that means is they're going to ask you for $7,500 after the 1st of July next year. Now, you are in the sort of almost fortunate position where we're 8 months out from that period. So what we're saying to clients is divide that by 8 and start putting that money away every month for the next 8 months. So that when you do go onto my.gov.au and disclose to them what your income is, you have the money there ready and waiting, and it's not going to be a surprise. You're not going to have to turn around and suddenly trying to find $7,500 that you may not already have. So be prepared for this. The sooner you act, the better the result's going to be. You don't want to be trying to save $7,500 3 months out. At 8 months out, you've got a bit of time. You can put money away. But also, don't forget, this is going to happen on an annual basis. So the sooner you get into the habit of doing this, the better off you'll be in managing your cash flow. Now, obviously, that $7,500 will get paid off your HECS debt or HELP debt or TSL debt. So if your HECS or HELP debt is at $30,000, then obviously your new loan amount will be $22,500. And then the following year, the same amount will come off again, and off you go, and you'll continue to do that until that HECS debt, HELP or TSL debt is fully extinguished. So long story short, if you can pay it off before then, fantastic. If not, you are going to have to get settled in for a couple of years of repayments in order to get that debt down. I've included in the slide there quite a good ATO calculator that you can actually type in your income, and it'll tell you the amount. Most people can work it out from the table on the side of the presentation, but at the end of the day, if you do want to play with the calculators and the tools, then that's that there, and we'll be also sending out that link later on as well too. So the last area we want to talk about is how to manage my Australian investments. Now, most people, when they move overseas, they do have something sitting back in Australia, whether it's shares, managed funds, property. So what we'll do is we're going to run through some of the key points on each one of those asset classes and point out why some work better than others when it comes to being an Australian expat in the United States. So the first one is, it's a good news and a bad news story. The good news is there is a double taxation limit between Australia and the United States. So if you do crystallise any sort of debts or pay tax on any income, that the IRS will take into account that tax credit that's already been paid to the ATO and applied accordingly. Ashley ran through some pretty scary numbers when it comes to US tax rates. Obviously, the double taxation agreement extends to federal taxes. It doesn't extend to state taxes. So you need to keep that in the back of your mind when you're working this out. The bad news is that the IRS and the US government doesn't treat all Australian asset classes favourably as others. So we'll run through some of those asset classes and talk about the pros and the cons, and hopefully give you a bit more information on that. So on property, a lot of people have property. Most people, when they become an expat, they will have what we call a principal place of residence that's back in Australia, they move overseas, they rent it out, and off they go. Quite often, because the Australians' love affair with property, they may buy further properties back in Australia, and this is a common strategy up until the 8th of May 2012. After that date, the Australian government changed the tax laws where if you are a non-resident and you own an investment property in Australia, you do not receive the 50% capital gains discount for holding a property longer than 12 months. So the problem with that is suddenly you will default into the non-resident marginal tax rate. And the problem with that is you'll pay 32.5 cents on the dollar on the first dollar. There's no tax-free threshold, there's no buffer. You will pay 32.5% on that first amount. So the biggest thing we find with clients when it comes to property is you need to go through and look at the numbers. The numbers sometimes may stack up, they may not stack up, but then you also got to look at what may occur in future years ahead. The other thing that people get caught out by is the IRS look at the exchange rate when it comes to you buying and selling that property. So let's say, for example, when you bought the property, the dollar was sitting at 80 cents in the dollar, and then you go to sell the property at, and the Australian dollar is at 70 cents. So therefore, the IRS will look at that and say, rightio, did they make a gain based on their currency as well as based on the buy and sell price of the property? So you need to be wary of that and need to make sure that you look at both numbers, because for people who bought property when the currency was a lot lower, there could be quite significant capital gains tax there that you need to take into account. The next one we're going to talk about today is managed funds, and Ashley certainly covered off on this well through his presentation. And essentially, from an IRS point of view, managed funds are considered as PFICs, so passive foreign investment companies. They are not taxed under the federal capital gains, they're taxed on the income side. So there is no benefit from a tax point of view in the US to holding managed funds in Australia. So what we often say to clients is you need to go through and crunch the numbers, and if you are going to be in the US for a bit longer, then do you crystallise now and take that liability now, or do you hold later, or do you defer that to later years? So you need to work out how those numbers stack up. But essentially, people have had the Colonial First State Invitation Fund, Perpetual, a lot of the sort of household names when it comes to managed funds, and they've been very useful in years gone by because they've been able to sort of almost defer management and you can get on with living your life. However, unfortunately now with the way that tax laws work, they're not so good. The other thing I'll point out as well is the currency comes into the equation as well too. So anytime you talk about an asset, you also need to look at the currency as well. So the IRS is looking at both issues. And on to the last one, which is obviously direct shares. And the good news with direct shares is that they are treated favourably by both jurisdictions. So that's a positive. A share portfolio held by a non-resident does not accrue capital gains tax with the ATO and is taxed under the US federal capital gains system should you crystallise a gain while you're a resident in the United States. So, like we talked about with the super fund, you try and limit turnover, you try and limit crystallising gains while you're away. And, these assets can accrue. Obviously you need to avoid investing in PFICs, you need to invest in bricks and mortar companies. So whether it's AGL, whether it's ANZ, Telstra, Wesfarmers, you need to invest in an operating company, not a company that invests in other companies as well too. So it's a very clear distinction. The other thing we'll point out too is you need to be careful. ETFs are very popular these days when it comes to saving money, putting money away, investing, basically because you can get with one transaction broad market exposure, whether it's on the Australian market, US market, or any other international market. The thing you need to be careful of is you need to make sure that if is the ETF you're investing in US registered. If it's not, then it'll be considered a PFIC. So there's a lot of ETFs listed on the Australian share market today, and also the US as well. You need to go through and if you are in ETFs, make sure that they are registered and are you essentially in US dollars as opposed to Australian dollars, because otherwise the IRS will take a very dim view of that as well too. So what we'd like to do is hand it open to any questions and queries that you may have now. As Ashley had to disclose, and myself, both of us being very compliant in a very compliant world, here's my general disclaimer, which we'll be sending out a copy of the presentation. So if you do suffer from insomnia, please feel free to read both of our disclaimers. They're incredibly exciting. My contact details can be found here. Once again, don't be too concerned about picking that up, because at the end of the day, we'll be sending out copies of each of our presentations. And what we'll do is we'll hand it over to questions, and I'll hand it back to Ashley.
All right. Can you hear me, Brett?
Yes, I can.
All right. Well, in that case, the questions are rolling in. There was one that was there for you, Brett, that was to do with HECS.
Yep.
And the ones that have been addressed that I've been able to answer, I've just answered them privately via chat as we're going here. But I'll read this one out. Okay. First question we have is, what if you're a member of a self-managed super fund in Australia? That's all it says. And I think the implication there would be, what's the PFIC status if you're a member of this? Then I think we'd need to know, are they a dual citizen or a green card holder? Because that's going to determine if the US has any interest in taxing that worldwide income, and then also what are the underlying holdings of that self-managed super fund. But it's my understanding that you can't have a self-managed super fund if you're not resident in Australia. Brett, what's your thoughts on that question?
Yeah, look, this is a bit of it's going to become a bigger problem as years go on, because self-managed super funds in Australia have been very popular for the last 5 years due to flexibility, liquidity, and a lot of other reasons. Essentially, for a self-managed super fund to be compliant, it has to have a lot of conditions met. And one of those conditions is control must be in Australia. Now, the problem with that is, if you are becoming a non-resident for tax purposes, clearly you are not controlling your self-managed super fund in Australia. So, if you want to have some sort of control, saying and understanding with respect to self-managed super funds, you then need to do one of two things. You either need to roll it back to what's called a retail or public offer super fund, which is essentially the vast majority of how we run our overseas clients' super funds, where you have a corporate trustee who's in Australia, but you can still call the shots when it comes to managing that. If you still want to maintain that self-managed super fund, then you have to go through quite a few hoops. And what it virtually means is you need to redesign your self-managed super fund so you are no longer the trustee. You have to reappoint a trustee who's resident in Australia, and there's a lot of strategies, whether you pick a corporate trustee with a director, or whether you do two individuals, and that's obviously quite a long conversation, and more than happy to take that offline. But at the end of the day, you need to have enduring power of attorney set up. You have to have an investment strategy that you are imparting on the new trustee in terms of how to manage your self-managed super fund. People have sort of been, blowing in the wind when it comes to the ruling about you not having any control while you're overseas. The scary thing about that is, if the ATO finds out, if they find a text message, if they find an email that shows you are controlling the super fund from overseas, then there is the very real possibility that you will lose 46.5% of your super balance. Now, if that non-compliance continues for a number of years, there's a very real chance you may lose 90% of your super balance. So the ATO view this as low-hanging fruit. You have to go to the nth degree to prove that you don't have any control overseas. The control is in Australia. If you don't have that proof, then the ATO will just come at you like a bull and take the money that they want to get. So, we recommend clients try and avoid using self-managed super funds. But if you can't, and usually that's cases like if you own property or other assets that are non-liquid assets inside your self-managed super fund, then you need to go to a lot of other steps to make sure that you are compliant in Australian tax law with the HECS Act. There's quite a few things that go through there, and we're doing more and more of these reviews, and people go overseas and pointing in the right direction in terms of how to make compliant changes, because the ATO take a very dim view to non-compliance.
Okay, moving on to the next question. It's actually the same question as the first one. It's essentially, as self-managed super funds taxed as PFICs. We just answered that. Are you going to discuss HERT taxation at all? I've got no idea what that's a reference to.
Okay, the HERT Taxation Act is actually a US taxation act that was originally set up to almost avoid US military servicemen who have been overseas for a number of years to hide assets overseas. And essentially what happens is, unless you're on very specific visas in the United States, you may fall into this. And virtually what it means is, if you're a resident of the United States, don't have to be a citizen, don't have to be a green card holder, if you're a resident of the United States for greater than 8 years, and then you do move overseas, then you are almost entitled and obligated, like with a US citizen, as part of FATCA, to disclose those overseas holdings. Even though you're no longer a resident of the United States, the biggest problem you find is there's a catch-all sort of scenario with FATCA and HEART and all these things. So even though the intention was to go after US expats and US servicemen and women, unfortunately Australian expats fall into that same area. So usually what we do is, with our clients, we sort of almost have alerts that when we get very close to that period, and we sort of discuss them, okay, at the 7-year mark, are you going to keep going? If you did have an intention to leave, might be sooner than later, might be advantageous to avoid falling into that HEART Act. But obviously, if you go in with your eyes open and you see that, okay, I'm in the US for 7 years now, I'm going to be here for another 3, at least you are fully aware and understanding of the obligations that you may fall into. So, we work quite closely with a lot of CPA attorneys in the United States when it comes to managing these types of events. And once again, fully informed is the only way to go. You don't want to go into this blindly, because you may move overseas after being in the United States for 9 years and not realise you actually have reporting and tax obligations back to the IRS, even though you're a resident in Australia and you're an Australian citizen.
Okay, next one. Are Australian stapled securities considered PFICs as an example? Westfield, Transurban, etc. That's Stuart's question. Answer to that is no. Those are, in fact, individual holdings. Brett, did you want to...
Spot on. Yeah, look, I mean, it's a very easy way to work out what's a PFIC. Are they an operating business? Transurban, they operate toll roads. Westfield, they operate shopping centres. It's only when you get a company that invests in other companies. So obviously an ETF, which is non-US registered, or any sort of investment company. There's a lot of listed investment companies. The best way to look at that is, if you look up LIC, which is a listed investment company on the ASX, you actually can get lists of what's considered an LIC. And the best thing to do is just avoid those totally.
Next one, favourite question of ours from Kate McBain. So I work in New York City for the next few years or thereabouts, and own property in Brisbane. I'm considering selling my Brisbane property as it's not performing well. What are my tax implications on the profit from the sale? Well, that all depends on when you purchased that property, Kate. It was June 1st, 2012, Brett, when the capital gains was changed for foreigners.
It's actually, the change was on the 8th of May 2012, but before we even go there, there's another classification. If the property was considered a principal place of residence, and then you moved overseas and rented that property out, you actually have 6 years where you can actually sell that property and you do not accrue capital gains tax with the Australian Tax Office. So we often watch that mark very closely. And once again, this is with respect to the ATO. It doesn't take into account the IRS obligations. But if you bought a property on the 1st of January 2010, you moved overseas on the 1st of January 2015. So you lived in it for 5 years as a principal place of residence. Then you sold it 3 years later. As far as the ATO is concerned, you have no tax obligations at all.
So Kate should be good in that case. She's just writing here that it was for 2.5 years from April 2013. So that that exclusion should apply in that case. But just expanding upon that, if that weren't the case, had it not been used as a principal place of residence in the prior 6 years, we just had a client case with this situation recently, and it's a good illustrative point. He had purchased the property in 2007, had never used it as a primary place of residence, and essentially he was able to get the 50% capital gains discount up until May 2012, and then from then on he would be liable for the full capital gains. So that's to say he needs to get a valuation done for what the place would have been worth 4 years ago, 4.5 years ago almost. So that's at the federal level, remember. Brett said it before. I wish I had made a point about it as well. The tax treaty is between the two sovereign governments. It's not between the states. So we need to remember that that depending on what state you live in and what income tax may be applicable there, you may owe state income tax on the capital gain of the investment property that you're selling in Australia.
No, spot on, Ashley. Yeah.
Okay, so next question here. I heard that if you're a permanent resident for more than 7 years, then you would be impacted by needing to file taxes in the US for the rest of your life, which would then impact your Aussie super. That's from Robin Ballard.
Okay, that's obviously the hard act that we were referring to before.
That's
so, yeah, and look, there are means and ways around it, and obviously this is where myself, Ashley, and other industry specialists work together to ensure that you can do it the most compliant way, but also do it in the most tax efficient way as well too. So that week I could talk for the next sort of 2 hours on those sort of issues as well. But long story short, it's something you need to be aware of coming into that period, and need to be aware of from a advice point of view, but also too from your personal limits. If you are able to leave before that period starts, then yeah, that may be the smart idea. If you can leave at 6.5 years instead of 7.5 years, then that's always a smart idea. But you need to make sure that you're aware of that arbitrary line, because things can change after that period.
Okay, now here's a question that we might not be able to answer, but we don't have all the answers. I don't think anyone does in this space. It's unbelievably complicated, and we do want to say that Brett and I are planning another webinar that will be focused in the other direction. So that is, what does it look like to return to Australia, or what does it look like to go to Australia if you're an American moving to Australia for a period of time and then interested in getting their superannuation back. That's a whole different ball of wax. But Glenn Robertson here writes, is it better to roll over my Australian super into my 401k? Well, you can't really do that until you're over the age of 60, and even then the particulars I'll ask Brett in just a minute as soon as I finish the question. So is it better to roll over my Australian super into my 401k, or keep my Aussie super separate in case I move back to Australia in the next 5, 10 or 20 years? What are the options or implications of each approach? So my quick take on that before I pass the mic to Brett would be, well, you can't simply roll your super over to the US. Your super is locked in Australia until you hit your preservation age of age 60, and apparently still there is the transitional retirement scheme, but it's my understanding that's quite a narrow number of years that you'd be looking at. So you're not rolling your super into the 401k. That's not going to happen. Could go the other way though, yet again, subject to age restrictions. If you want to do it in the most tax efficient way possible, then you'd be waiting until you're older than age 59 and a half, because that's the magical age 59 and a half in the US, where you're able to take your retirement contributions without penalty. I'm not sure if that's necessarily going to gel on the Australian side, if you need to be 60 or not to make those five times $100,000 tax-free contributions. Brett, what's your 2 cents here?
Yeah, probably the first clarification is the only exception to being able to pull your super out before preservation age is if you're on a temporary resident visa, like a 457, or any of those sort of work visas where you're here for a short amount of time. Obviously backpackers and a lot of people sort of fit in that boat. Usually what we find is people coming in on skilled visas for a short period of time, and they're not considered permanent residents, can sometimes pull their super out with a condition of release being met by the respective super funds. If you don't fall into that boat, then yeah, I mean, we all joke about with clients saying that super's like the mafia, once in, never out. So until you meet that preservation age, you've got very little options to move that super. Obviously, in a perfect world, there would be a compliant one super scheme that covers all the countries, and we can move it back and forth. But I think we're many, many years off before we get to that stage. So in the meantime, sometimes people actually don't mind having a foot in both camps. They don't mind having a a 401k or an IRA and also a super fund, because it's almost like a hedge. They're maybe not sure where they're going to come back to, where they're going to live in the future. So they've got a foot in both camps. They've got assets accruing in both camps. And at that point, when they know where they're going to retire to, the general rule of thumb we say with clients is you want to accumulate assets in the country you intend to return to or retire to. So if you're going to retire in the States, then all your focus should be on moving your assets to the United States. If you're going to retire to Australia, then your focus and attention should be on moving those assets to Australia. So that's the easiest way we say to clients when they say, where should we park our money? And people don't realise, as an expat, your greatest risk is currency risk. And all we need to do is talk to Australian expats in the UK right now, which we do on a regular basis. The pound's at record lows. Their net worth is essentially 16% less than it was pre the Brexit vote. So you need to work in with your intentions both in a short, medium, and long term. If the Australian dollar is going to be a lot stronger in 20 years' time, it may be worthwhile holding on to that money. Just going back to the person asking the question, it depends on how old he is too. If he's 30 or 40, then he could be 20 years off that preservation age, or 25 years off. If he's 55, then maybe there's other things we can use like TTRs and stuff. The problem with the transition to retirement strategy is you can only pull 10% out per annum, and it's for a very finite period of time. So usually what we say to clients is as soon as you start a TTR strategy, then you have to start lodging Australian tax returns. Do you want to go through that obligation? And most people say no. So that's where we say, okay, rightio, just hold off for another 5 years, wait till you reach preservation age, convert it into an allocated pension, do a 100% drawdown, move the money overseas, and off you go from there.
Okay. Question that got skipped some here in the mix was from Tom Medhurst. Can you have two principal places of residence, one in Australia and one in the US? I think that comes down to the definition of domicile, and the answer there is no. You have one primary place of residence. Right?
Same for the ATO. The ATO, as soon as you tell the ATO my PPR is this, because essentially what you're doing is you're picking up, I guess, the tax benefits of a PPR. So you can't apply the no CGT benefits to two residences. So as soon as you say this is my principal place of residence, with house B, therefore you're losing the tax benefits of house A. So you can't, sort of cross-pollinate.
Is AMP a PIFIC? I'm just going to answer this one. Well, AMP, the stock, is not a PIFIC. AMP, the fund manager, Australian Financial Services license holder, and the products that they provide would be a PIFIC. Okay, next. If I earn income from this is from John Spears, if I earn income from foreign exchange with a third party in Australia, do you think this will be classified as a PIFIC? If so, what is being treated unfavorably? If so, what is being treated unfavorably by IRS mean? Well, firstly, it's not a PIFIC. That's simply foreign exchange gain, and that is taxed at ordinary income. I wouldn't say that's punitive, but it's not favorable either. It's not a tax efficient way to make an income. And Brett and I share a philosophy there, and that is you really need to focus on the net return that you take home after fees and taxes. So that's a great example where you might have a nice return, top line return, but once you've paid your ordinary income on that, it's perhaps not as attractive a way to earn a return.
I think also too, one thing that I didn't present in the slide, but it's worthwhile mentioning to people who have an intention to move back to Australia, is the ATO give you 6 months from the day that you return and put your hand up to say you're a resident. 6 months in that time frame, you are able to move assets from overseas back into Australia. After that 6 month time period, and if you make a gain either on capital appreciation or on the currency, then the ATO will view that as you gaining the system. That they will view that as you've had 6 months to organise your affairs and bring everything back. If it happens in 8 months, then you can actually pay tax both on the capital growth and or the currency gain as well too. So that is another thing that catches clients out as well.
Right. Okay. Good question from Gemma here. Is the 8 years in the Heart Act 8 years total over a lifetime or 8 consecutive years?
Look, I'll put my disclosure hat on first and say, when it comes to the finer details, we're not US registered tax attorneys. We're Australian registered tax financial advisors. And this is where we draw on, and both Ashley and I tend to work with the same partners. We draw on these tax attorneys to go through and look at that. It's actually a question that we can look up and send that later on if you like. So because it is a very good question, because we often find with our client base, we call them satellites because they just keep orbiting Earth, and they'll move from New York to London, back to New York again. So let's take that advice, that question on notice, Ashley, and we'll actually put it out later on.
All right, sounds good. So Robin's coming back into the conversation. So if I move home at the 6-year milestone, can I just return to normal in Australia, or are there other tax implications I need to consider? She's currently been overseas for 3 years. So this is the lady, just to refresh your memory, who wrote in an earlier question, heard that if you're a permanent resident for more than 7 years, and you'd be impacted by needing to file tax in the US for the rest of your life. I actually think that Robin might have been responding to someone else's question that was asked earlier about the 6-year exemption. So she's 3 years in. Brett, anything else to say there other than it's a 6-year exemption, therefore presumably she's got 3 years to go. Are there any other tax implications she might be mindful of, quite aside from foreign sourced income if she's renting out the property in the meantime? And the need to file extra time.
Yeah, essentially, Robin was one with the property in Brisbane. Is that correct?
No, I don't. No, actually, but I think that's what she was responding to. Was
okay.
That.
When you come back to Australia and if you move back into your PPR, then the 6-year time frame resets again. So if you have a place in Brisbane or Sydney and Melbourne, you move back into the country at year 5 or 5.5, and it becomes your PPR again, and you live there for another couple of years, then it's from the time that you leave that house, then another 6 years goes on from there. So we do have clients who go overseas and come back and keep resetting it, and essentially they're in a very favourable position. Do you want to be moving your family around that much? So it's up to you.
Okay. This is a great question. I love it. It's from John Spears, and he's asked, if I'm here for only 1 year, maybe 2, is it generally worthwhile continuing tax returns in Australia with the ATO and not, well, I don't know about not the IRS. The IRS doesn't really give you an opinion as to whether you want to do it. I'll take a stab at that one. That's a great point to illustrate what I was trying to get at in one of my slides there about your immigration's intentions, really determining what your overall financial investment strategy should be. So if you only intend on being in the US for 1 or 2 years, that's to presume that you have income that is being sourced from Australia, which is going to be real estate most likely, or if you happen to own a business there. Then you're going to have to file tax returns. But if you're intending on returning to Australia, then you would not be wanting to further complicate your financial life by owning US sourced income that you're then going to be forced to file returns on in the future. An interesting thing to note, this is a really, really interesting thing. I had a conversation yesterday with one of the partners from the international tax firm I referenced earlier. And I asked him, so what if a visa holder, a temporary visa holder, moves back to Australia but still has, say, an investment account in the US? Are they subject? We know that they're going to have to pay taxes on that income, but are they subject to the worldwide income? No, they're not, and they might even, if they're, depending on the value of the account, they might even be able to skirt having to file taxes at all. And this plays to a major trend that's been underway for a couple of years, and that is because of FATCA, the IRS has made it so difficult for banks and investment companies to comply with that, that if you're not really a significant client to them, they're going to send you a letter in the mail that says, thanks so much, it's been a pleasure doing business with you, your account's now closed and we're done. Why? Because they are going to be, you would notify them and say that you're no longer a resident, that actually your address is whatever it is in Australia, and depending on the value of that relationship to that custodian, they may well close your account, or they will withhold the taxes for you at the appropriate rate and simply pay it on your behalf, in which case you have no tax obligation and therefore no need to file a return. But the overarching point here to the question that John asks is, don't complicate your financial life unnecessarily by digging deeper roots in a country that you only intend on being in temporarily. You want to cut the cord, be done, and simplify your financial life once your service here is up.
I couldn't agree more, Ashley, and that sort of goes back to my comment before about accruing assets in the country you intend to return to or retire to. You know, quite often we might have clients who are engineers or people who worked on fixed contracts and bounced through the world. And you know, we did a review the other day for a gentleman based in South America, and he had 7 international bank accounts. And when we actually went through and worked out how much in annual fees he was paying, and he closed 5 of them down, we were able to save him about $1,200 per annum. You know, you do accrue baggage as you move, and you know, I think John's hit the nail on the head. You want to simplify things, you know, and it quite often, you know, if you do it before you leave Australia, it's even easier. But even while you're overseas, you can do it as well too. And you know, with respect to property versus shares, if you do have an Australian property, you have to lodge a tax return. If you have just a share portfolio in Australia, you don't have to lodge a tax return. And the reason behind that is with property, the tenant will pay you the income, and then you have to remit back to the ATO either tax on that income or a return to show that you are negatively geared or neutrally geared. With the shares, the way that works is they deduct what's called withholding tax from the dividends, and the share registry does that before they pay you. And quite often when we sit down with clients, you know, usually virtually like this, and we go through their scenario and look at what they're wanting to achieve, quite often they say, well, I'll sell my property in Australia under the 6-year rule. I'll have a share portfolio which will manage in compliance with both the states and other jurisdictions, and they won't have any reporting obligations back in Australia. So, you know, it depends on what you want to achieve. If your heart's in your property, well, then you have to go through the registration process of filing annual tax returns. The other thing I'll point out as well too that a lot of expats don't realise is that just because you jump on a plane, the ATO doesn't know you've gone. So what we often say to clients is you need to file a final lodgement with the ATO to notify them that, you know, you're moving overseas for an indefinite period of time. Any accountant can do it. It's not an expensive process, but it's just good housekeeping, because then, you know, the ATO knows you're going overseas and they're not going to be chasing you for future tax returns as well too.
Okay, great. Thank you, Brett. So here's a question from Estelle, and she's asked, I've heard that this is a great question, and I don't know the answer to it. I have come across it recently, but we haven't seen it through. I've heard that depreciation on Australian property cannot be claimed against US income. That is, if the Australian property is negatively geared. It has no benefit to and then restated as a question, it has no benefit offset to US income tax. What's the best way to manage a negatively geared Australian property? And my first stab at that would be what I've always said, depends on your domiciliary intentions. If you're coming back, then maybe it's worth your while to hold on to it. But Brett, please take it away.
No, I think you hit the nail on the head, Ashley. It depends on your intentions. If you've got massive accrued capital gains that, you know, would be quite punitive, then you may not want to hold off on that. The first thing I'll question though is obviously, you know, expats can't negatively gear because they haven't got an opposing income to offset the loss from the investment property. So essentially what you do is you accrue tax credits back in Australia, but you can only use those tax credits when you return to Australia and offset against that your Australian-based income when you live back in Australia. So, you know, when it comes to, from an ATO point of view, you know, they're getting more and more restrictive in terms of what you can and can't do as a non-resident. You know, from a depreciation allowance with respect to the IRS, obviously that would be Ashley and other partners, domain, because we don't get involved on the US side. We're aware of these issues, but we're not aware of how the IRS treat depreciation allowances that the ATO normally would. So, and that's a very important point, because just because the ATO treats something one way doesn't mean that the IRS is going to treat it the same way too. So you need to make sure both sides are covered. A classic case in point is franking credits on dividends. Now, the Australian ATO will give you 50% tax credit from those franking credits. The IRS doesn't recognise franking credits. So you need to be aware of both of those two issues, and not just hang your hat on that one, I'm doing this because of the franking credits, because by the time that information gets repatriated back to the United States, it may not stack up. So you need to make sure that you're doing, working your investments with the benefit of both jurisdictions.
Yeah, so I think we're 20 minutes over time here. Questions keep rolling in. We probably have to draw a line under it. It's getting late in certain parts of the US. But and Brett, how do you feel about that, or would you like to keep going?
Oh, look, I mean, it's morning time here in Australia, so I can keep going all day, but being cognizant of the fact that people are probably hungry and tired and everything. So, I mean, what I often recommend to clients and people who have been on the webinar to do is, if you want to shoot myself or Ashley an email, what I'm going to do is, just after this, I'll shoot out a quick email to everyone to provide our contact details. Ashley, myself, I like to call us digital advisors. So, we're talking to people in many jurisdictions and different time zones and everything. So we're more than happy to answer these questions offline, because what we often find is when there's one question, there's five. So you may need to have that deeper conversation with Ashley and myself about some other issues as well too. So I'll send out an email with our respective email addresses that you can contact us on offline. And then, we can take those questions further and, obviously get to the bottom of the answers.
And I had a great question, and wouldn't you know it, Stuart just responded at that very second. And a great question to leave it on, and that was there was a question here that a gentleman was satisfied with the comments that were made here tonight. Brett was wondering which one of us to engage depending on his issue, and so my answer to that, I wrote a chat answer, and I said it depends on where your issue is primarily to do with. If it's to do with a superannuation or Australian related question, then the best place to start your inquiry would be with Brett. And if it's to do with assets in the US, then the best place would be to start with me. Obviously, we have a pretty close relationship, so if it's something, if you come to one of us prematurely or incorrectly, then, and it's not something we can help with, then there's no friction, cost or issue involved with simply referring that issue onto the appropriate party.
No, look, exactly. I mean, I say to clients, look at the Pacific dateline. If it's this side of the dateline and it's my issue, it's the other side, then it's Ashley's. So look at the jurisdiction, and think of the Aussie hat versus the US hat.
All right, wonderful. Well, that's about a wrap, I think. Thank you, everyone, for attending, and a set of wonderful questions. And please feel free to reach out. As Brett mentioned, he'll be providing our contact information. And thank you so much.
Have a great evening, guys, and thanks for attending.